Good morning, it's Jeffrey Christian. It's about 10 after 11 o'clock here in New York on Friday, the 6th of September. I want to talk today about ways that investors and producers and others can protect against lower prices and volatile prices. It can also profit from them. So I'm going to run through some of the strategies that we have used over the last 4 decades for our investor clients as well as for producer clients and others. Before I do that, let me just say that today we saw a jobs report in the United States which did not live up to some people's expectations. There were good aspects about it, lower unemployment rate, and there were some bad aspects to it. Initially, the financial markets got all giddy and thought that this probably increased the probability of a 50-point decline in the Fed funds rate in September when the FOMC meets. Gold and silver rose along with other assets. I think that the giddiness wore out and they realized that we're pretty much where we were Thursday afternoon, and the prices have come off. As I speak, gold is off about $4 for the December COMEX futures contract at $25.39. And silver is around $29.12, have up about 2.6 cents, having clawed back over $29 an ounce yesterday. Platinum and palladium are up modestly. This just sort of factors into what we've been saying all along. The environment is that we have heightened volatility in gold and silver prices, and we expect that to last over the next several months. Not just leading up to the U.S. elections, but in the aftermath. Additionally, we have been talking for some time about the potential that gold and silver prices may peak at some point in the next 21 months and come down significantly. Not back to $1,600, we don't think, but somewhat high. If you look at a long-term gold or silver price chart, you'll see that when the prices spike $50 for silver in 1980, and then it came back down, and waited about 30 years, in 2020 some odd years, and in 2004 it started rising, got up to $50 in 2011, came back down, and gold has done the same sort of thing. One can easily say, yes, the prices of gold and silver can rise further, and on a shorter term basis, but when you see these kinds of spikes, usually brought about by spasms of investor concerns over economic and political and financial stability, 1980, 2008, 2011, and whatever comes in the near future, the prices ultimately come back off. And rational investors know that, understand it, and they seek to profit from it. They seek to take profits, and they seek to position themselves to even profit from lower prices while preserving their long-term long positions. And that can be done. The solution is for investors and producers to maintain and retain their long-term physical positions. In the case of investors, it might be physical metal or a combination of assets, including stocks, gold mining stocks, silver mining stocks. And in the case of producers, it's their long-term, the price of their products in the long term. You can do that, and while by protecting against lower prices in the short term and in the long term, and actually putting in options positions to profit from those lower prices, all the time preserving your ability to profit from rising prices because you've maintained your long physical position. You don't have to do that, but you'll be a lot wealthier if you actually take advantage not only of the long-term potential for price appreciation in gold and silver, but also in the shorter term and intermediate term price moves. We've shown you charts, comparative charts of somebody just bought gold or silver and held it for the 46 years that we've been keeping track of our buy and sell recommendations versus going long and then going to cash at times versus another portfolio where you go long and when you're bearish, you go short. You do a lot better if you manage your position. I think there's something in the good book about the talents. You do it with options. You can take options positions that profit from volatile price moves up and down. CPM Group, in preparing for this video yesterday, Thursday the 5th of September, Carlos Sanchez, my partner who really sits on top of our hedging and managed accounts business and advisory work, structured butterfly options, which we really like, and I'll show you a couple old examples, as well as some strangles and some straddles to take advantage of the current volatility and the potential that prices may move higher as well as moving lower. Now, he structured these and priced them yesterday so we could see what was being done, and we will be distributing that information to our clients over the next 2 business days. We're not showing it to you here because that's our intellectual property. That's what people pay us to help them do. But if you're interested, you can become a client and we can work with you. So rather than show you what we structured yesterday, I'm going to show you 2 butterflies that we put together. One was on October 7th in 2016. It was a month before the 8th of November presidential and congressional election in that year. And we were looking at the candidates, Hillary Clinton and Donald Trump, and we said, wow, we know who loses this campaign, this election. This is going to be volatile, and it's not good for the economy or the country, whichever one wins. There are douchebags that talk about how they assume I'm a Democrat or was a Democrat. They don't know squat about what they're talking about. I've always been an independent, and I continue to be an independent. I have certain attitudes that may be a little bit harsh about both participants in both parties. My politics don't matter here. What matters to me is my knowledge and my ability to protect myself and my clients from adverse moves politically, economically, and in the financial market. In 2016, we looked at the 2 presidential candidates and said, yuck, and it's going to be volatile leading up to the election. That was the important point. So on October 7th, 2016, we structured a butterfly. It cost our clients $4.70 to put in place. On the 9th of November, the day after the election, we liquidated those positions. The net gain was $5.90 an ounce. That's 125% profit over the course of a month. Not too bad. Now, you don't need an event like an election to put together butterflies that work. This is one that we did in May of 2017. There was no specific event that we were looking at. We just said, hey, we think the gold market could spike higher for a time, or rather drop for a time. So we put together this initial trade on the 11th of April, and we liquidated it less than a month later on the 9th of May, and it made 161.5% return in a month. So you could sit there and say, I'm just a simple person. I'm just going to stay long gold and silver, and you will do okay. But you can also say, let me sit up straight and think about how I can employ my wealth to not only preserve my wealth, but also to make profits from it. You don't have to, but it's pretty interesting if you do. Now, investors can also buy long-term gold long positions with a principal protection. That means that if you bought, and here's a chart showing the principal protected managed account that Carlos structured yesterday. The spot price at which he structured it was $2,511 an ounce. It's a 5-year managed account. You can actually liquidate it at any point if you need the money, but over 5 years, I cannot guarantee it. Your principal is protected, right? If you hold this position for 5 years, your principal is the same as what you put in initially. In addition to that, if the price of gold rises, you make virtually all of the upside exposure right now, given where the prices are right now. And the forward price for 5 years is about it's more than $2,800 right now. So if you think the gold price is going to be rising over the next 5 years, but you also think it could fall, you can put together a managed account with CPM Group. We structure it, we price it, we place it, we can even manage it, and we will manage it for clients. And you can say, okay, if I hold this for 5 years, my principal is protected. I earn back what I invested. And if the price rises, I'll make additional profits. And if I want gold, at the end of the 5 years, I have the ability to take delivery of the gold that I bought at $2,511. So if the price is $10,000, like the pumpers say, you'll do very well. If the price is $2,600, you'll do very well. So that's another way that investors can buy long-term gold exposure, protect their principal from lower prices, and benefit if the prices rise. Another strategy that we use for producers and investors is a compounded option program where we can lock in a minimum price that you'll receive for your gold, and you can profit from most of the upside. Here's a chart of something that Carlos structured yesterday. It has a floor of $2,400. The wags might say, yeah, but the price is $2,540, and I know it's going to $10,000. But it's been above $2,400 very short amount of time. And over this is priced for 1 year. So between now and September of 2025. You can be guaranteed that you can sell your gold at $2,400 an ounce. Between that and $2,650, which is a price to which gold has not yet reached, you get the market. You're fully participating in an upward move over that $250 range. If the price continues to rise, you can still sell your position is still profitable, but you will give up $175 of the upside over $2,825. So that's another way that you can protect yourself from lower prices and continue to profit if the price rises. That's what I have for today. Next Wednesday, we will be doing an open forum, which is an open question and answer session for our clients. Our clients have gotten invitations to join that. They've also gotten invitations to send in questions ahead of time. We don't have a scheduled presentation for these open forums. We do them every quarter. So this will be the third quarter one. It'll be next Wednesday at 11 o'clock Eastern Time. And We don't have a formal presentation, but people will send in questions. And then you also have the right to type in, or sometimes I'll remember to turn on the two-way microphone, and you can actually ask the questions orally as well as writing them down. We usually have more questions than we have time to answer, and I apologize in advance. It's a good sign. It shows a great deal of curiosity and knowledge on the part of our clients, and we like working with smart and curious people. So that's next Wednesday. If you are a client, you can register for it. If you are not a client, you can become a client. You can send an email to info@cpmgroup.com, and we'll help you get in the door next Wednesday. That's all I have. Take care of yourself. Take care of those around you. Try to do something good for the world. Have a good weekend if you take weekends. I think I'm probably going to be at my desk for at least part of the time because things are very busy right now. In the meantime, take care.